Are you thinking about investing but don't know how to start? You've probably asked yourself, how do I invest in the stock market without losing my money? Maybe you've been thinking about investing your money, but the stock market feels like this big, confusing, and even intimidating place. You see charts, numbers, and hear terms like bull market or bear market, and it just feels overwhelming. You're not alone in feeling that way. So many people feel the same when they first start thinking about investing. That's exactly why I made this video. My goal is to break down exactly how to start investing in the stock market in a way that's simple, clear, and easy for any beginner to understand. Let's just chat for a moment. Building wealth for your future, whether it's for retirement, a down payment on a house, or just financial security, can feel like a really daunting task. Saving money is important, absolutely, but just saving might not be enough to keep up with rising costs over time. This is where the stock market comes in as a powerful tool. Investing in the stock market essentially means you're buying tiny ownership pieces, called shares, of publicly traded companies. When those companies do well, their value tends to increase, and so does the value of your shares. Historically, the stock market has provided impressive returns over the long term, often outpacing inflation significantly. This means your money has the potential to grow substantially over the years. Learning how to invest is truly crucial for securing your financial future. It's about making your money work for you, not just sitting idle. Okay, so where do you actually begin? It might sound complicated, but honestly, getting started is much easier than you probably think. The very first step you need to take is opening a brokerage account. Think of a brokerage account like a special online bank account, but instead of holding just cash, it holds your investment assets like stocks and funds. This account is where you'll deposit money and then use it to buy and sell investments. It's your gateway to the market. There are many reputable brokerage firms out there, both online and traditional. You might have heard of names like Fidelity, Charles Schwab, or newer platforms like Robinhood. It's a good idea to do a little research to find a brokerage that fits your needs, considering factors like fees, available investments, and ease of use. Most offer online account opening, which is quite straightforward. The second crucial step is to define your investment goals. What are you investing for? Is it for retirement decades away, a down payment on a house in 5 years, or maybe funding your child's education? Having clear goals helps determine how much risk you should take and how long you plan to invest. A long-term goal like retirement allows for more aggressive strategies than a short-term goal. The third step is perhaps the most obvious. You need capital, which is just a fancy word for money. You need funds to actually buy investments. Now, here's the good news. You absolutely do not need a fortune to start. Many brokerages allow you to start with very small amounts, sometimes as little as $50 or $100. The most important thing is simply to start somewhere, even if it's small. Consistency over time is far more impactful than waiting until you have a large sum. All right, you've got your account, you know your goals, and you have some money ready. Now, what should you actually buy? For beginners, I highly recommend keeping it simple. Dons feel pressured to pick individual hot stocks right away. Fantastic options for beginners are index funds and exchange-traded funds, often called ETFs. These are essentially baskets that hold many different stocks or bonds. When you buy a share of an index fund or ETF, you're instantly diversified across numerous companies. This significantly reduces your risk compared to putting all your money into just one stock. A very popular example is an S&P 500 index fund. This single investment gives you exposure to the 500 largest companies in the United States like Apple, Microsoft, and Amazon. Another relatively safe bet for beginners can be investing in blue-chip stocks. These are shares of large, well-established, and financially sound companies. Think of companies like Apple, Microsoft, Johnson & Johnson, or Coca-Cola. These are household names that have been around for a long time. Blue-chip companies typically have proven track records of profitability and stability. While no stock is completely risk-free, they are generally considered less volatile than smaller, newer companies. Figuring out the perfect time to buy can feel impossible, and honestly, trying to time the market is incredibly difficult, even for experts. So, what's a beginner to do? A strategy I highly recommend for beginners is called dollar cost averaging, or DCA. This is a simple yet powerful technique. With DCA, you invest a fixed amount of money at regular intervals, regardless of whether the market is up or down. For example, you might decide to invest $100 every 2 weeks. This approach helps you avoid the stress and futility of trying to predict market movements. You buy more shares when prices are low and fewer shares when prices are high, averaging out your purchase price over time. Remember this key principle. Time in the market is generally much more important than trying to time the market. The longer your money is invested, the more time it has to grow. As you start your investing journey, there are a few common pitfalls that are best to steer clear of. Avoiding these can save you a lot of stress and potential losses. First, try to avoid chasing hype stocks or jumping on every trending investment you hear about. These often involve high risk and can lead to significant losses if the trend reverses. Investing based on solid principles and long-term potential is usually much safer than following short-lived fads. Do your own research rather than just following the crowd. Second, resist the urge to panic sell during market dips or corrections. The stock market naturally goes up and down. Fluctuations are a normal part of investing. Selling during a downturn locks in your losses. Often, the market recovers over time, and staying invested allows you to benefit from that recovery. Third, avoid going all in with all of your available investment money at once, especially into a single investment. This concentrates your risk unnecessarily. Spreading your investments across different assets and sectors, which is called diversification, helps mitigate risk. If one investment performs poorly, others may perform well, balancing out your overall portfolio. Investing isn't about getting rich quickly. It's fundamentally a long-term game. Adopting the right mindset is crucial for success and peace of mind. This journey requires discipline to stick to your plan, patience to ride out market ups and downs, and a willingness to continuously learn. It's an ongoing process. Manage your expectations realistically. You are building wealth over years and decades, not overnight. Focus on building a solid foundation with diversified investments and making consistent contributions over time. Small, regular investments add up significantly thanks to the power of compounding. Staying informed about general market trends and the economy is also important, but don't get bogged down in daily noise. Focus on the big picture and your long-term goals. So there you have it. We've covered the basics of why to invest, how to get started, what types of investments are good for beginners, when to invest using DCA, and what common mistakes to avoid. My hope is that this video has helped demystify the stock market for you and given you the confidence to take your first step. Remember, everyone starts somewhere. If you found this guide helpful and feel a little more confident about investing, please give this video a thumbs up. It really helps the channel. And if you want more practical tips and guides on personal finance and investing, make sure you subscribe to the channel right now. Don't miss out on future videos. Also, hit that notification bell so you're alerted as soon as new content is released. Now, I'd love to hear from you. What is your #1 question about how to invest in the stock market after watching this video? Let me know in the comments section below. I'll do my absolute best to read through the comments and answer as many of your questions as I can. Your questions help me create better content for you. Thank you so much for watching all the way through. I truly appreciate your time and interest in taking control of your financial future. Happy investing, everyone!